might trickle in, but for the most part, I think, we're going to get started. I brought Mark in today, at the very beginning of the semester. I touched on it last night. One of the fund's weaknesses is, not having price targets on, our current holdings or any of the things that we really pitch. And from now on, Ebord and myself have kind of decided that that's going to be a needed part of every pitch. That's going to be on those sheets so that 4 years from now, when all of us are graduating with Mark, enjoying, not having any fun drinking anymore, that those guys can look back when they're hammered and say, well, why do we own and what's the price target and stuff like that. So Mark's going to go through his way of, kind of evaluating a firm and things that we can use in our pitches to really strengthen that side of things. So without further ado, I'm going to pass it on to Mark. He can present, I'm pretty sure. And, pay attention. Learn stuff.
Right. Let me figure out how to. I have to present this. Okay. What does everybody see? Does everybody see a spreadsheet?
Yeah, we got your spreadsheet up.
Yeah. Nice. Okay. So today we are going to. I guess I'll walk you through my valuation of Beyond Meat and what I did here. So before you start doing any kind of valuation, the first thing that you need to know is that all models are wrong and that some are useful. So whatever you put into here, it's wrong. Like that, I can guarantee you this is not how the future is going to play out. Like, you are not clairvoyant. If you were, then you wouldn't be wasting your time doing this. So to start evaluation, the first thing you do is you can go ahead and what I've done is I've input the firm's last 2 years of financials, income statement, balance sheet, and cash flow. I have highlighted there. So I've input those two things into the spreadsheet. The next thing I did is, because this company, I wanted to start from fiscal year 2020. I went and I took all of their quarterly financials and I rolled them into a spreadsheet here and then estimated the fourth quarter. And the way I did the fourth quarter estimate was I basically took for revenue, I took analyst consensus numbers and numbers from management's presentation, as well as for some things, when you go through this, I was pretty much finding the growth rate of plant assets and just keeping it the same to estimate the fourth quarter. And for most companies, this is what you'll do. They'll have 1, 2, 3, or 4 quarters of data. You're going to go ahead and put that into a spreadsheet and find the last 4 quarters to estimate the current year. And that's really it for the current data. So these 3 years are essentially just the current data, everything year to date that they've already published and everything that you can easily find in their investor presentation. The next 4 years are where you have to think a little bit. So to start doing this, you kind of need a thesis on the company, and you kind of have to figure out how you're going to estimate everything. What do you have to think? Where do you see the industry going? Where do you see the sub-industry going? So plant-based meats, where do you see this company going in the industry? What's its current market share? How's it going to grow? So I usually start when I'm doing evaluation with kind of a thesis, like an investment thesis for the company. So my fundamental thesis that I base this on is that I'm shorting this company because, well, I think that it's going to grow incredibly well and plant-based meats are going to be the next big thing. I think the companies like Nestle, Tyson Foods, and everything else that are already making investments into the space are going to stop them from growing the necessary market share to sustain the valuation that it has today. So nothing against the company or the industry, but I just don't think that their valuation is sustainable. So to try and prove that, what I've done is I'm going to go ahead and I'm going to do evaluation now. To start, the best place to start is by estimating revenue. So what I did is I put all these numbers into thousands too. So that's when you look at it. That's why you'll see some of them multiplied by 1,000 when you look through. So when I went to estimate revenues, what I did is I basically took the entire plant-based meat market, which is worth about $4.3 billion. I went online and I found I did it through my company's research portal. I'm sure you can find reports on different industries. And I found that the plant-based meat market is expected to grow at a growth rate of about 14%. So what I did for 2020 is I took their sales in 2020 and I divided the sales in 2020 by the entire plant-based meat market to get Beyond Meat's market share in 2020. And then this is where I kind of started, you're going to need to use some dubious extrapolation here to kind of figure out what their sales are going to be in the next 4 years. So in 2021, what I did is I went ahead and I grew the plant-based meat market by 14% every year. And then I assumed that their market share would grow to 14% in 2021 and continue growing, slowing down up to 20%. And then simply just multiply their market share by the total market that I estimated, kind of gives me their sales figure. So that's one way you can use to estimate revenue for a company. There's many other ways to do it. And if you, for example, if you have a mature firm, you can go ahead and you can most likely just take them and multiply them by the industry growth rate. If it's a mature industry where the company's not really gaining or losing market share, usually the industry rate of growth is what the company's going to do. In a case like this, I had to assume that its market share was going to continue to grow. Otherwise, on the next screen, when you look at the discounted cash flow, like their valuation would make absolutely no sense. So you have to assume that they're growing at gaining some kind of market share. So now that I have revenue estimated, the next place I'm going to go is the next line item down on the income statement, cost of goods sold. Cost of goods sold, the best way to forecast it is usually as a percentage of revenue. In some cases, you won't do that, but if you're valuing a real estate investment trust or something, you're not going to do that. But for most companies, this is what you do. So what I did is I took all of their comparable companies, their competitors, and I found what the cost of goods sold was for them. And I basically found the average percent of their sales that are spent on cost of goods sold. And if we go down here to Beyond Meat, what I assumed is I took their 2020, the percent of revenue their cost of goods sales was, and I took the industry average and I said, well, as they scale up, their costs are going to scale with them. They're going to kind of get towards the industry average, basically. So I took the percentage of cost of goods sold and divided it by 4. So over 4 years, if it grows by 2%, they'll hit the industry average. Is that what that assumption is saying? And so basically on a linear scale, I have every year and the percent of the cost of goods sold that it is. And then you'll be able to see in the cell here, once I have those estimates, I multiply sales by what percent of sales their cost of goods sold is going to be. Once again, like I did this on a linear way. If you were doing this, I'd probably use a log linear trend line just because that's more realistic. That's probably what's going to happen. I just didn't do it. I was just lazy. So I just used a linear trend line. I mean, that's fine. And then next we have then we'll get their gross profit. So revenues minus cost of goods sold will give you gross profit. Next, we're going to do their sales, general, and administrative. And that's typically forecasted the same way. It's just a percentage of revenue. And I did the same thing. I found the industry average. I found what they had. And then I calculated basically what percent if it just linearly approached the average. So it would drop by 5% a year. Then that's that. Multiplied those by the numbers in the cells. The next cost that I estimated, research and development, and I did the same thing as cost of goods sold and sales, general, administrative, just kind of getting them to the industry average. For a company like this, that kind of research and development model makes sense. Usually they're probably going to grow about the same amount every year as they try to introduce new products to scale up and gain market share. There are other companies, like if you're looking at a biotech or something, that's not the best way to estimate research and development. because you're going to get numbers that like vary widely from year to year. So it is kind of industry specific when forecasting these things, but for the most part, this will get you by in most industries. And then from there, I estimated their restructuring charge, but basically I just took the percentage of sales that was restructuring and reduced it by 5% a year. Um, Typically, newer companies like this will continue to run and incur restructuring charges, but I didn't want to have it keep growing. So my assumption was that they'll get more efficient in the charges they incur. So I just kind of trickled it down by 5% every year. We'll come back to EBITDA because well, we have to go to depreciation next. So to forecast depreciation, all it's going to be is the change in accumulated depreciation from year to year. And I'll tell you how I forecasted that. So to forecast depreciation, what I did is I took the plant assets. So first I forecast like the amount of plant assets they're going to have in 2021. So what I do is you're going to use what's called like a balance sheet efficiency ratio here. So you're going to take the property, plant, and equipment, and you're going to divide it by the growth rate in revenue. So what that's basically saying is for every dollar in revenue that they grow, they're putting, an extra 6 cents or whatever into property, plant, and equipment. Right. So the property, plant, and equipment is actually growing faster than revenue. And for a business like that, and for a business that's, relatively young like this, that does make sense because to scale from 100 million to a billion, you're going to need to exponentially increase the amount of property, plant, and equipment. Scaling from a billion to 10 billion, once you have enough plant and equipment, that's pretty easy. You're not going to actually grow as fast. In general, there are some cases where that's not true, but for something like this, once you build up the plant, you're good. So that was kind of my assumption there. So once I found that ratio, I basically took revenue growth for the year and then multiplied it by that ratio. And now that I know how much it's plant and equipment supposed to grow every year, I went ahead and just grew plant and equipment by that amount when I multiplied it. You can see there. So now I have the plant assets for the year. Now that I have plant assets, I got to find the accumulated depreciation account. Now, this is one where you're going to want to look in their 10K. They're really simple with their depreciation. They pretty much do it all straight line, and most of it's over 5 years. So because the company tells me that, I know that I can basically grow. I know that their depreciation is going to stay pretty constant at around 29% of whatever it is their assets are, because it's all straight line and it's almost all over 5 years. So as they're growing assets, they're generally depreciating the same amount of stuff. So I didn't get too into it trying to, move a few million here or there. I just kind of said, okay, they're going to stay the same. So what I do is I take their assets and I multiply the percent of their assets that should be depreciation. And now I have estimated depreciation for the next year. Then I can just take the difference in depreciation, and that's what their depreciation and expense in 2021 should be. So now that I have their depreciation, I can calculate EBITDA, basically gross profit minus the other expenses, add back depreciation. There it is. So that's their EBITDA. Now from EBITDA minus depreciation, EBIT, earnings before interest and taxes, their interest expense. This company in particular is weird with their debt. This is another one where you're going to want to go into the company's 10K and you're going to want to see what's the rate that they're borrowing at and what's their plan for borrowing. They do not have any plans in the immediate future to issue long-term debt. That will likely change in the next 4 years, but I can't forecast for that because I don't know. So I have the rates, the interest rates on their revolving credit and on their short-term credit from their 10Ks. And I just went ahead and forecast their short-term credit and their revolving credit. and then I'll multiply that by the interest rates. The way that I forecasted their short-term and long-term credit, let me get this here. I used, what you can see here is I used this ratio that's I used the debt to EBITDA ratio off of their balance sheet. And I did the same thing as I did with the cost of goods sold and sales general administrative, where I took their current debt to EBITDA and the industry average and just have it linearly decline towards the industry average. And then I assumed that 80% of their debt was going to be long-term, 20% of it was likely to be short-term debt, just kind of based on what they'd had in the past. So 80% of their debt, of that ratio times EBITDA, that's their long-term debt. 20% times the same ratio times EBITDA is the short-term debt. And then for interest, 3.5% of the long-term, 4.5% of the short-term was the estimate. For other non-operating, I ended up just keeping that as a percentage of sales. So it's about negative 0.2% of sales. They usually have, like, as they're shuffling equipment around and gaining new or changing their assets around, they tend to have these one-off gains on sales of assets and everything. So that's kind of there to account for that or to act as a buffer for that. Next up, I have, and then from there, just subtract those two things from EBIT, and you'll get the earnings before taxes. In 2021, I have them losing money, so I'm going to assume they're going to pay no taxes. In the past, it looks like they've, paid a couple thousand, but so it's not really material. I'm not going to worry too much about that. And what I did for every other year in 2022 is I just assumed a 28% tax rate because that's what it looks like is likely to happen. It looks like the tax rates are going to increase for corporations to 28%. So I just went ahead and made that assumption for years following. Now we're going to get onto the balance sheet. So the way that you forecast a balance sheet is it's pretty much all going to be using these kinds of ratios that I use to get to some things on the income statement, with the exception of cash. Cash is forecasted through the cash flow statement, which we're going to do next. So, and you can do the cash flow statement first, kind of, but I think it's easier to do the balance sheet first, then forecast the cash flow statement. So we're going to start with accounts receivable. The way that I forecasted accounts receivable was I used the receivables turnover ratio, which I have calculated here for you. It's just revenues divided by average accounts receivable. And then what I did for all of for the industry comparables is I found what's the receivables turnover of a mature company, because I'm assuming they're likely going to approach that. So they have receivables turnover ratio of 15 on average. I figure, okay, what does their ratio need to increase by to kind of match the industry? So it needs to grow by about 1 every year. So they're going to get slightly more efficient at managing their receivables, is my assumption. So what I did is found the ratio, and then you'll see in here the equation looks kind of strange, and that's just you're basically just going to take the equation with the average receivable, the revenues divided by average receivables, and then X is just going to be the second receivable in the average, and that's going to kind of give you the equation that you need. A useful tip for solving these, if you don't want to try to write out or figure out the equation in Excel, is you can just go to Wolfram Alpha, type the equation in, and put X in as the variable you want to solve for, and it will actually rearrange the equation for you, so you can just type it straight into here. Makes it super easy. So I did that. I have the ratios going all the way across. Good to go. Next, we're going to do inventory. For inventory, I used the inventory turnover ratio, and I did the same thing with the industry. I took the industry average and basically said that's where we're going to go in the next 4 years. Receivables turnover, same for accounts receivable. On the liability side, I did the same thing. I just use the industry average and the current ratio that they have, and then what are they going to need to get there, and then you can see the equation in that's payables turnover. My bad on liabilities. Yeah, there's the one for payables turnover. That's what it looks like. Again, for that one, I'd recommend using Wolfram Alpha. The payables turnover ratio is a little trickier to solve for. It's cost of goods sold plus current inventory minus past year's inventory divided by the average of payables. So if you find it like tricky to plug those into Excel, definitely use Wolfram Alpha for that. Okay, so now that I have those in, we're going to go back up to prepaid expenses. Let's see what I did. Basically, I did the same thing where I took the prepaid expenses to sales for the let's see what I can't even remember. Yeah, I just took the difference between prepaid sales in the current year and the past year, and I just said it's going to be somewhere between there. So I just kind of have it move, kind of between those two numbers. I mean, and prepaids can be kind of hard to forecast, especially if you're this company and they're signing all kinds of operating leases and prepaying whatever is all the time. I wouldn't really know how to forecast that without spending a lot more time on it. So that was kind of my trick. Total current assets, sum of all those assets, and then property, plant, and equipment I showed you earlier. For other long-term assets, I just kept those the same. In general, that's perfectly acceptable to do if you have a category on the balance sheet or something that you don't know where the company's headed or don't know what they're going to do. I mean, keeping in mind that any number that you put in there is going to be wrong, like anyways. I would just go ahead and leave it rather than put in a wrong number that you forecasted, super high, and then it's way off and your valuation is not even close. At least this kind of keeps it a little more down to earth when you do it. Payables I showed you. For wages payables, I just had them grow at a constant rate because I really don't know. I mean, without working at the company, I wouldn't know what their policy for accruing these wages payable are. So, and it looks like and when I checked, they grow at a pretty similar rate every year. So I just left it, growing at the same rate. Same thing with accrued bonuses. I just put a 0.7 in front of there to kind of slow down the growth rate of accrued bonuses. So they're not, so those don't get like too out of whack or start to look like they don't make sense basically. Accrued expenses. I did the same thing where I basically just had those also grow at the same rate, kind of the same as, I did is the same as the other things. That's kind of generally what you do. Like if you don't know how something is going to trend on a balance sheet, if you look at it for 3 or 4 years back or whatever they have, 3 or 4 quarters, and it just kind of trends at the same rate, generally it's acceptable to just kind of leave it trending at the same rate, or if you find a ratio that works with that company to do that. Stock warrant liability or short-term capital leases I kept the same again because I don't know what their plan for these leases are going forward, and I didn't see anything, so I just kept those the same. Stock warrants, that was a one-time thing in 2018 before they went public, so that'll sit at 0. Total current liabilities is the sum of all those. And we'll look at the revolving credit agreement. That was when I showed you how I forecasted the liabilities. So you got that. These long-term bank loans were the same thing. They were a one-time deal before they went public, and these equipment loans, those aren't going to show up again. Capital leases, I kept the same again because that's just one that you can't really forecast well without knowing the company better. And then on the equity side, the convertible preferred, this was from before the IPO, so that's going to sit at 0. Additional paid-in capital, that's going to stay about the same unless they decide to sell stock. Once again, without working there or being in management, I wouldn't know the plans. I'm just going to keep that the same. Common stock, that's just a standard balance sheet item that doesn't change. Other comprehensive income, this is what I use is if you're in Hall's class, he talks about using a plug on the balance sheet. That's what I'm using this as. The reason I did it is because it kind of makes sense to use that as your plug for a company like this, where they have foreign exchange rate risks. They throw like all kinds of weird costs and other things in other comprehensive income. So I'm just going to kind of use that as kind of the catch-all for everything else I didn't catch. Retained earnings, their retained earnings balance is negative, mostly because they've been losing money forever. So if you keep losing money, your balance is going to be negative. I mean, so that's fine. Then just total equity is the sum of those. Liabilities and equity, I just set that equal to assets, and then I'll use the plug to solve to make sure it's balanced. So yeah, I realized that was a lot. So if you have any questions, you can just like interrupt me whenever. And I know this is being recorded, which should help you if you want to watch that again. Now we're going to go down to cash flows. This is pretty straightforward, just like pretty basic accounting. All you're going to do is net income, depreciation, and you've already gotten most of these things. So you have, share-based compensation. This is a cash flow item that I just had grow at the same rate, just because I don't know I know their stock purchase plan, sits at about the same, and they grow at about the same rate every year. So I'm just going to keep it where it is. So that's how I got that. And then all these other items are just coming straight off of the balance sheet, unless you're amortization, then you grow at the same rate. But yeah, all this is just straight off the balance sheet. And then to get cash from operating, I'm just going to take the sum of all these. And then investing cash flows, all these other like proceeds from assets for sale. Generally, people don't forecast those. They just use the property, plant, and equipment purchases as like the main investing cash flow, unless the company has like an extremely predictable investing cash flow every year. This company doesn't. They're pretty much their only major one is PP&E. There are some companies where you could see, pension liabilities or stuff showing up in the investing cash flow. That one's fairly predictable, and that's one you're going to have to account for. And then, there's a few others if they're like, if you're an oil company and you're selling off like a ton of assets all the time, you're going to need to forecast their asset sales in your investing cash flows. But for this company, they're pretty much only really purchasing plant because they're still growing. So I don't need to worry about any of that. And then for financing, same thing. I'm just pulling everything right off the balance sheet. And then I just grew the proceeds from option exercises by, I just called it 6% here. And you can look in their 10K to kind of see what options and everything they have outstanding and what's going on there. I mean, I looked at it for a minute and just kind of assumed 6% is a safe, fairly conservative estimate. So that's why I did that. That was just a pure judgment call. If you were doing this, you might want to look into that more. Debt issuance costs. Again, this is pretty much like, I don't know why. So any year that I had them gaining cash from the revolving credit facility, I just went in and threw in an issuance cost. It looks like they pay a standard of about $1 million whenever they do this thing. So I just did that. I just put that in there to kind of account for it. Cash from financing, sum of all those items, and then the net cash increase is the sum of all three. And then you'll take the cash balance from last year, you'll add the cash increase, or in this case, a decrease, and then that's the cash for this year. So that'll be the last item that goes onto the balance sheet. So in general, forecast everything else first, then do cash at the end. And then once you have all the formulas in for those years, you can go ahead and just drag them to the right. It'll do the last 4 years. Now, the thing with balance sheets and everything in all of this is obviously start simple when you're covering a company. I would start with basic percentage of sales and basic efficiency ratios. And then over time, as you read more of the earnings reports and you kind of learn more of the company as you follow it, you'll be able to kind of update and build this model. Because like that's why I kind of keep everything outside, like on this side, out of the balance sheet and everything. Because over time, I will, I will tweak little things as I learn kind of more of the quirks of the company and everything. So when you start, you'll start basic, and then you'll over time kind of expand. And then as far as actual valuation, now that you have everything forecasted, the method that I chose and the most common method for companies is the discounted cash flow method. And this is actually really short, like it's super easy to do. Once you understand like the equation and everything, it's not super hard. So we're going to start by actually calculating the free cash flows. So to calculate free cash flow, it's the earnings before interest and taxes times 1 minus the tax rate plus depreciation and amortization minus the change in net working capital minus capital expenditures. That's the equation. So net working capital is over here. I calculated it. It's just the change in non-cash current assets. It's non-cash current assets minus non-cash current liabilities. That's net working capital. The change in that is just the increase or decrease year over year. And you subtract that when calculating your free cash flow. And then capital expenditures, in the case of this company, is just the change in property, plant, and equipment year over year, because that's all they're really buying is property, plant, and equipment. There are some companies that will be purchasing other long-term assets in addition to that. You'll put that into CapEx as well for those companies. That will give you the unlevered free cash flow. Next, you're going to need the discount rate. For this company, I used the CAPM model, the capital asset pricing model, to kind of find the required rate of return on their equity. Since this company doesn't have much debt at all, and I couldn't look on Bloomberg quick to see what the capital structure is. I just went ahead and assumed 100% equity, and for them it's fine because they're like 99% equity. But the capital asset pricing model is just the current risk-free rate, so current 10-year treasury yield, plus the company's beta times the average equity return minus the risk-free rate. And that will give you a percentage. That's what you're going to use as the discount rate. That's the company's hurdle rate. That is what it needs to return in order to add value. So we're going to find the present value of all these cash flows. First 3 years, they're actually going to be generating negative cash flow, which that's intentional on my part. A young company like this will typically generate negative free cash flow in its first few years of operation. That's nothing to be alarmed at. And then I have it you'll see it grows rapidly. It multiplies by 5 or 6 or whatever in 2024. Or 7 in 2024. So then I'm just going to take the sum of those and put that down here. Now, when you do that, you kind of have to assume that there's going to be some exit at some point to this company. Either the company is going to grow at a certain rate forever, or you're going to exit the company for a multiple of EBITDA or a multiple of sales. And so I've done it all 3 ways so you can see how I arrived at an equity value. And then I'll tell you kind of what kinds of companies you do for each, or what investments you might do for each. So first I started with the Ebitda multiple. Basically I took the industry average Ebitda multiple and I kind of stuck that at the top. That's what we're going to use. To get the terminal value, you're going to multiply the industry average multiple by the last year of forecasted EBITDA. And then you're going to take the present value of that. So you're going to discount that back 4 years. And there's the present value function in Excel that's super handy for doing that. So you don't have to actually type the equation. Enterprise value is the sum of this present value and all of the cash flows. Then you're going to calculate net debt. So you're going to take all of their, basically the net debt is the difference between the long-term assets and the long-term liabilities. So other way around. Yeah, the net debt's the difference between, you can see here, it's assets and liabilities, the difference. Um, and then you're going to take then you're going to take all the non-operating assets. In this firm's case, it's just cash is what they have as a non-operating assets. And in terms of non-operating liabilities, they don't have any on their balance sheet, which is lucky, so you don't have to worry about that. To get to the company value, it is just enterprise value plus net debt minus non-operating assets. And then if you had non-operating liabilities, you would add those in. And the reason you add the debt and subtract the cash is because let's say you were to buy the whole business. You would need to add the debt to the value of the business because you would still owe that. You would have to pay that off. And then you subtract the cash from the value that you would pay for the business because if you bought the business, you can just take the cash and pocket it. So that shouldn't factor in. And then I took the number of shares outstanding. You divide the company value by shares outstanding to get a target price of $8.53. Now, Beyond Meat is trading at well over $100. Why did I get this? Because the Ebitda multiple is not the best one to use for a company that's still in its early growth stages. You generally use an EBITDA multiple for a more mature company on an investment with a 4 to 5 year horizon. And the EBITDA multiple is most often used when you're acquiring a company. So, um, like if a private equity firm were to attempt to acquire this company a few years ago, they might have paid $500 million for it or whatever. But when you're publicly traded like that, it's going to be a little different. So. This is mostly used by investment banks, but this can be useful with public securities as well. The next one that I did is the other assumption that you can make, and this is a reasonable assumption, is that the company will grow its revenues at a certain rate forever, assuming you'll hold it forever. Now, with this one, I used an equation called the H model. Uh, I'll write that in here for you so you can look that up. Basically, it's a way to take perpetual growth. You'll assume that in 2024, I forecasted a 24% growth rate. It obviously can't grow at 24% forever. So I said that long term, it's going to grow at the rate of the economy, which is about 3%. So, and my assumption is it's going to take 6 years. So I used this H model equation, which you can see it in here. It's probably best if you look it up to see what the equation looks like. But I use this equation, and that will basically calculate the value of the business if it grows at 24% now, but over the next 6 years, it drops to 3% and then grows at 3% forever. So then you go through the same steps. You have the present value of this value, add it to the cash flows, debt, you go to company value, and then $6 per share. Once again, like crazy. Well, clearly something's wrong with this. The reason is usually with it's the same thing, the same assumption with the business growing its cash flows forever. With the business that's in early growth stage, it's hard to know that it'll only be 6 years before it hits that 3%. It could be 20 years. It could grow at 12% for 20 years. Like we just don't know. This is generally better for a company in its later growth stages or something else. The best multiple to use for a company that's younger is as a multiple of sales, because at this stage people are going to pay for the revenue that it can generate. That's really all they care about. Because in theory, if you bought this business and you were a larger company and it can be generating $1 billion in revenue in 4 years, you are operationally efficient enough to basically take it and make it profitable. So most investors, will think the same way, because if it's, way overvalued on the EBITDA multiple, why do they exist? So they have to think sales. So what I did is I just took the company's enterprise value to sales multiple for the past year. And I assumed that, that was basically what the market valued it at in 2019. Forward looking, the number's a little lower. The industry average is 2. Obviously, you're not going to pay 2 for a company that's this new. So I just assumed last year. But to get to this number, same thing. You multiply sales by the sales multiple. You'll take the present value of that. add that to the cash flows, plus net debt minus non-operating assets to get the company value divided by the number of shares. $81 per share. Company's trading at 111. All right, well, now what am I going to do? I'm going to be buying the $110 puts January 2022. It gets down to 81. They'd each have $3,000 in intrinsic value. I can buy those puts for 2,100. So I'm looking at a decent upside in a year. So I'm going to go ahead and buy a few of those. There you go. And that's kind of how you use valuation if you're attempting to trade equities, mid to long term, basically, which is kind of what the fund is doing. So, and then obviously the DCF is only one way to do it. If you wanted to, you could look up residual income. You can do it with discounted dividends. That's the other way that a lot of people do it. Since this company residual income relies heavily on accounting data. And with the company that's accounting data isn't, it's very new. It's hard for me to look at the accounting data to kind of create that model. So I'm not going to do that. They don't pay a dividend, so can't do that. So I'm going to go to cash flows and I'm going to use a sales multiple because that makes sense for this company. So with that, I will send this model to Venkat and he can share with you. At some point, I will try to start typing comments in places on what I did if I have time. And then if you have any questions, feel free to ask.
Yeah, if anyone has any questions, you can ask now, either in chat or through your voice.
Mark, so you said you used CAPM to determine required return, right?
Yep.
Is there typically a better method than that? Because I know that's a pretty basic, just especially with a company like this, because it's new and the beta might be a little funky.
Yeah, the best way to do it. I mean, so with this company, ideally, what I would actually do is I would find the optimal capital structure. Like, so I would look at the capital structure of other businesses and figure out what the optimal one is. And I'm still going to have to use the same beta and everything and require to get the equity calculation, but I would add a debt component in maybe 2022 or 2023 based on the capital structure of other businesses. And then I would end up using the WACC from those for the last 3 years probably.
Awesome.
So I would kind of forecast capital structure a bit.
Anyone have anything else? All right. Well, on behalf of the fund, Mark, I appreciate you coming back. Appreciate you making this this sheet and taking the time out of your evening to help us. For each one of y'all, I know that stuff, might look a little bit difficult initially, but as Mark said, you kind of start small and then you can continue to build things as you get to know more about the company. So it is a little bit less daunting than it seems, at least right now, especially as you continue to learn. With that said, Mark said he was going to share this with Venkat, and we'll send that to each one of y'all. What I'm going to do is kind of strongly encourage team leads or any other people who are, extremely interested in continuing to grow to go ahead and do this for one of your own funds. And then I'm going to have David, who is another alumni, come back within the next couple of weeks. And, he'll come in. It'll be a little bit smaller. It won't be PMC, but it will be an opportunity for y'all who completed this exercise, or if you have another method of doing it by yourself, to go in and ask him questions, and he'll ask you questions about your assumptions and how you got your numbers. Because the presentation is wonderful, but as I said before, a lot of you joined, is the way that you learn how to do this stuff is by sitting down and doing it and digging through the financial statements. So that's definitely a way to continue to grow. So again, I thank you, Mark, and we'll look forward to seeing what the rest of the fund can do with this over the next year.
Yeah, well, thanks for having me, guys. Have a good night, everyone.
Yeah, thanks, Mark, for this.
Mark.